Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Even though we are still currently under the 2017 Tax Cuts and Jobs Act rates, their expiration date is right around the corner. Our current rates are set to expire in 2025, and depending on the 2024 election, these rates could either be extended or destroyed. This means many of us may be looking at the lowest tax rates for the rest of our lifetime. Craig Ferrantino, he is the president of Craig James Financial, breaks down the potential tax changes that may happen in 2025 and later, also to offer strategies you should consider now to help preserve your nest egg and make your future less tax toxic. Craig, it's great to see you. Welcome to Trade Talks. I mean, of course, it's the first thing I think of is toxicity when you're doing your taxes. And we're looking at some of the lowest tax rates that we may ever see in our lifetime. Right now. Right. Now, the Tax Cuts and Jobs Act made several significant changes to the individual income tax. What does that include?
Well, it actually had the standard deduction now is almost for married filing jointly would be $26,000, and was started at $24,000. So it's tied to inflation, which is great. In the old days, you would have to like deduct everything, and so that's the environment that we're in now. And so it's important to know that we're in the lowest tax rates in our lifetimes, and I would say that very easily. We've never been at a lower tax time, and it stimulated the economy for a long time. So for the period that was there. However, that's going to sunset at the end of 2025. So clients, investors, everybody has roughly about 32 months in order to make themselves less tax toxic for the future. So we can talk about trading, it's a different angle. It's like, oh yeah, I got great companies for you and we can make money on these companies. But it's really about how much you keep. It's not how much you make. And in the end, we're finding that a lot of retirees or people close to retirement are realizing that they may have some big numbers, but when it finally gets to them, it's a lot smaller number, and it could be a lot smaller number come 2026, January 1st. So we have, again, 988 days in order to make some changes to make yourself less tax toxic for the future. And so I've been pounding the table on that, Jill.
What are some of the areas that affect most individuals in the future?
Well, certainly capital gains is one of the things that's important. So that goes back to the old capital gains rate, which is tied to your income brackets. Right now, it's a much more wider rate. So you could person making under like $77,000 pays zero capital gains tax, and then goes up to 15, and then after like 500,000 or so in income, then you're at the 20%. In the future, that's going to go back down. So if you have a property or if you have something that's on our what you could possibly do list, is to actually take some capital gains in the next 32 months that you feel that if it's something you're going to sell years from now, your taxation on the gains, embedded capital gains, will be less now than they might be in the future. As a matter of fact, I know the administration was looking at changing the capital gains rate even sooner than the 2026 expiration date. So I know that's been batted about a bit.
Well, of course, it depends on who gets in for 2024, as you had mentioned before.
Well, I don't want to get into politics, but yes, there's two plans out there. Kevin McCarthy was just down at the Wall Street doing a speech, and then Biden responded with that. So I think they're still far apart as we're talking about the debt ceiling. But all of that debate, if they're raising the debt ceiling, all this has to do with your and my pocketbook. And so we're going to have to figure that out.
Of course it does.
That's right.
So what are some actions one should consider today?
Well, yeah, I think the most salient one, and it depends on each person, and it's a lot of pencil pushing in terms of getting it right on paper, is to really take a look at the Roth IRA. Because I think that if we could start to move money, you have future liabilities in an IRA. So if you have, I don't know, $1 million in an IRA, I tell clients, I go, you'll never touch $1 million. I know it's a good number to look at, but you have unfunded liabilities in this IRA. And if you liquidated it that day, maybe you'd come out with $600,000 or so, $625,000. But if you do it over time, you're still at a much lower number. So if we could start to pay the taxes now, while we're in the lowest tax rates in our lifetime, I think that's the key. So you start moving some, not all at once, but we have 32 months to do that. We have 2 more fiscal years to do it, actually, the 3. So you divide that by 3, and you start to move some of that money over into a Roth IRA. If you're in it for 5 years, you're over the age of 59 and a half from the date that you first start doing it, you'll be able to take that money and reap the benefits and all the great stock picks and everything else. After 5 years, you keep all that for yourself. So to me, that's where the bulk of my experiences that we're trying to pound the table on is for clients. It's just a good advice all around to make yourself less tax toxic. Any monies that you take out of a Roth IRA is tax-free to you currently, which was, I think that'll stick. And then if your kids inherited or whatever, the next generation inherits, that'll also be tax-free as well. So I think it's very, very important to do that. So that's your first one. Number two, really, I think, Jill, is capital gains. Again, we talked about that just briefly, but make sure you take advantage of the lower capital gain or the wider bands before it jumps to 15 or 20%. It's a very wide band. In the future, under the old tax rate, before the Tax Cuts and Job Act of 2017, was that we were at the 39.6, and that was immediately the 20% capital gains rate. So, and it was tied to your income. So, and then the third thing I think is, and much less smaller, but some people are just looking and say, hey, I have to take out this required minimum distribution. I'm over 70 and a half, the new one's 72, but in the IRS code still, it's still 70 and a half in terms of a qualified charitable distribution. So if you have $1 million, you have to take out $60,000, whatever the required minimum distribution is. I won't give you the exact number, but the key is that's all going to hit my income. So now I'm going to show, let's say I have money coming in already. Now I just added another 60,000. If I could take 30,000 of that and make a donation to some charity that I like, the American Cancer Society. I could just think of 100 charities, thousands of charities that could do that. If you write a check directly to them up to $100,000, you'll actually be able to, that's a total deduction that will not hit your tax return. So the third strategy really is a qualified charitable distribution, and it's very, very important to take advantage of that because I think that also gets things off your tax return. In the end, it's not how much you made. It's great that you made a lot of money. Okay. It's going to be how much you keep.
Yep. All right. Appreciate the insight, Craig. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.